Okay, so good morning, everyone. Welcome to the new week and the macro snapshot. We are Monday, May the 12th, 2025, recording this at about 7:40 in the morning. Okay, so obviously the very, very big news coming out over the weekend was essentially over in Switzerland. We had a trade Secretary of the Treasury Secretary Besant, talking with his Chinese counterparts, and essentially a fairly sort of positive a joint press communique. Apparently later today there's going to be something with more detail, but essentially the tone was good, the sentiment was good, the feeling was good, and sort of in terms of specifics, which the market has absolutely loved and to create a risk off, was that the US, both US and China have reduced their tariffs by about 115 basis points. So essentially in the US, it's gone from 145% down to 30%. And for China, that's 125% down to 10%. So a significant reduction. It was always kind of symbolic, but essentially they've agreed to also put a sort of a moratorium on the situation for about 90 days to further negotiate. And so the market from that very simply has taken a very sort of positive risk on. All of the risk on assets are up, commodities are up, risk offs are down. So, a very, very clear market reaction. The question going forward is whether what happens with the budget, whether Trump's budget actually does turn out to be anti-growth a little bit in terms of cutting spending, if they're going to keep on issuing long-term bonds to pay for anything, recession, all this kind of stuff. But at the moment, at least in terms of what's happening today, we have a risk-on sentiment, and the market is essentially sort of going, yay, all clear. We shall see. I don't think that's going to be the situation which will last longer, because essentially today, we had ridiculous tariff levels of 145%, and now they're down to 30. I repeat, these levels, both imposed by the US and imposed by China, are still historically much greater than they've been, for the last 100 years or so. So the thing is, there's a sort of a sense of euphoria in the markets this morning, but it's going to be very, it's going to take a lot of hard work to actually come to sort of concrete solutions here. And although the initial signals are positive, we'll see what happens. And medium term, if Trump actually wants to get down the deficit, and that's what the sort of Besant is saying, this is a sort of an anti-growth kind of sort of a formula, which is not great for stocks in the medium term. We shall see. Let's just look at the market reaction. So pretty significantly here in the SOFR curve, obviously what's happening is that we've had a front end led bear flattening, because what's happening here, we'll just actually look here. You see here that it's pretty incredible, this move in the last 12 hours or so. You see here the one I've been looking at with everyone for December. We were at 4 cuts about 2 weeks ago. We're now down to just over 2 cuts. So suddenly the market is saying only 56 basis points of cuts by the end of the year. And some commentators are saying that even maybe that's a bit optimistic. If the economy keeps on roaring, inflation remains sticky, maybe the Fed will not cut at all. So who knows, maybe this goes down to 25 basis points or 1 cut. And just to put that on the intraday chart, you see the very strong moves as the European session opened this morning at about 3 o'clock a.m. You can see that was down about another 6 basis points. But to be honest, this sort of hawkish repricing based on the fact that the economy, there's going to be some deals done. Remember, we had the big famous deal with the UK a couple of days ago on Friday. The economy seems okay. Inflation seems to be sticky. So the market essentially, I don't know how much further I have to go and scroll here, but if we actually go back to, so this is 100 basis points of cuts. So if you go back to the 1st of May, which is only sort of 11 days ago, the market, as I say, was pricing at 105 basis points. So over 4 cuts, and now we're down to 2. So the market has taken out 2 cuts at this point. For those of you who think that, there's a reasonable chance of recession, this is starting to represent quite interesting value to go along the very front of the curve. So 2 years, or maybe SOFR, December 25, June 26, December 26, something like that. And that's interesting there to look at that. Okay, the other thing I just want to look at, just to see in terms of the SOFR curve here, you can see that this is the live data, which is the white line here. And you can see that Obviously, that's moved up. This is the implied yield. So you can see that that's been repriced hawkishly compared to this 1 day ago. So you see 1 day ago, be curious to see even 1 week. What was that looking like? Yeah. So if you look at 1 week, which is the sort of this orange line, and 1 day is the blue line. So you can see it's been substantially repriced in a hawkish way. And you can see that, let's say, for example, just a week ago, the terminal rate in about September of 2026, that was priced for, looks like about 3.19. Keep in mind that the effective Fed funds rate at the moment is 4.33. So you had 4.33 to three, let's call it 3.2. So that's about about 115 basis points of cuts. And as you can see, that's been repriced hawkishly quite a lot. Now, the other thing to note here is that not so much at the front end, the next few months, the market hasn't changed that much. Really, where we're seeing the massive pricing, as I've mentioned a couple of times, is pushing the pricing out into 2026. So, potentially some kind of trade of, sort of long June and sort of short, September of 26 would have been very effective. But again, this was all depending. It was a very binary outcome. We didn't know what would happen in Switzerland on Sunday, but kind of interesting to keep an eye on that. Now, if we do get again the opposite, so let's say the trade deals are less easy to come by. Communication starts to break down with China. Trump says something stupid. Let's say, for example, also the data starts to weaken in the US. The Fed starts to sort of say, maybe we will need to cut a little bit more. This kind of relationship will reverse very quickly, and suddenly the front end of the curve will start to price in very quickly, at least maybe 3 cuts for this year, or even 3.5, something like that. So that this kind of relationship will switch. Other things. So let's just now look at some of the markets. Pretty clear risk on. So at this point, it's really a question of seeing where we could get to. So we've got oil here. So let's have a look at oil. So this is I just had a little bit of a long trade here on the August contract. So let's put it on the front contract here. And you can see that, basically there's been a big sort of breakout here. And so the oil market loving the fact that the global growth may not be as affected by sort of trade disruptions, also potentially more demand from the US and China, et cetera, and generally positive sentiment, despite the strong US dollar. So oil here, you've got to say that this could probably, possibly just wants to retest this local high here at about, let's say about $65, could even push up to this. Is a pretty key level here. Which is this sort of horizontal level here, which is about 65.30. And also, of course, the first barrier here is going to be the 50-day moving average at 64. So I think we'll try and hit 64, and then probably this sort of, recent high at about 64.80, and then about 65.30. So that's just going to continue to chunk through those. But again, this is going to be a very sensitive market, like all of these markets. Any sort of communication which comes out, which puts into question the possibility of a speedy trade deal, I think we'll see oil coming down on all the other markets. Just while we're in the commodity space here, also seeing gasoline sort of pushing very high. Of course, we're going into driving season in the US. Gasoline actually outperforming crude here. You see it's above the 200-day moving averages, and the 20 and the 50 moving average starting to turn up. So gasoline looking quite strong here. Overall, let's just look at the currencies as well. So the dollar loving this. So we have the dollar index sort of pushing, breaking out here. It had been sort of coming back over the last few days or so, hitting the 50-day moving average here. That looks like a first kind of resistance here. And at this point, maybe that's the euphoria. It's going to be quite interesting to see here. I'm just going to put a fib reversal on. We can start putting a few different levels here to see. So that's interesting that the dollar, as it hit the 50% fib on this most recent downtrend, which coincided with the 50-day moving average, just finding a first resistance. But for the moment, that natural if that take a pause. What's actually going to be more important is to see, if the bulls want to step in on any kind of mini retracement. Now, most of the pain here has been taken by the euro. You can see the euro here also hitting its 50-day moving average and just sort of coming down here. Again, it's going to depend on future communication. What was interesting, we just had some headlines this morning from Besant, the Treasury Secretary, essentially saying that the EU, the Eurozone was, not coming to the front of the queue and was much slower in terms of making a trade deal. So could it just be that we have a bit of softness in European assets for a while? It's possible. So the euro taking a bit of pain here. We see the US dollar up against the Canadian dollar. We also see something like the Aussie not doing that well, because although the Aussie should be a risk-on kind of currency. It just there's so much US dollar strength that the Aussie against the US dollar not doing great. But if you look at the Aussie against something like the JPY, the Japanese yen, you see that in the cross pairs, the Aussie is doing very well. What's also interesting is that the safe havens obviously under a lot of pressure. So the Japanese yen being sold off pretty hard. The same situation here with the Swiss franc. So a classic kind of risk-on situation, and no surprise, obviously, that equities are absolutely ripping. So first of all, let's also look at VIX. We see the VIX here is absolutely, I don't want to say collapsed. It's not like at 12 or 13, but certainly the VIX down a lot. It's definitely now filled that kind of Trump gap, here for the tariffs, which I had sort of signaled here with this box. So it's now well below that. So for sure, that this is a positive news for equities in terms of low volatility. Again, just to repeat, it's still not at 14 or 15, but for sure 20 is a lot less than, let's say, 25 or 30 kind of range. So this actually represents anyone interested in doing sort of long gamma, so long put constructions, long call constructions, or even for portfolio protection, something like that. This is actually getting much more affordable. So that's an interesting sort of thing to think about, that the cost of sort of long gamma is actually much cheaper than it has been for about sort of a long time, basically 2, 3, 4, 5, 6 weeks, as you can see here, going all the way back to the 1st of April. So basically about 6 weeks before the whole tariff thing. Now, obviously, on the equities, so if we look at the futures here, obviously huge pop higher by about, what are they up at? 2.5%. So very, very strong performance. No shocks there. Now, what's interesting, I have to be honest here, is that the Trump gap has been filled. So quite interesting here that the Trump tariff announcement, which was on the 2nd of April, about 4 p.m., we've actually gone below that. So for the first time, we've broken out. We're breaking back above the moving averages here. So in one fell swoop, we've basically gone above the 100 and the 200-day moving averages. The 20 and the 50 are starting to turn up. So this is interesting. So, I mean, a lot of sort of the trend following, like the CTAs, are also kind of short positioned here. So I guess quite a few of those will start to be closing their positions and other general short covering. There's got to be a lot of stops as well by just normal players at this 58.50-ish kind of level. And then also this is another very, very key level we're getting up to, just which we paused at about 58.75. So stops are being broken through here. And if we get a little bit higher, there's probably going to be more stops triggered. So it would not surprise me if we get up to, maybe even like something like 5,900 or something like that, even up to 6,000 or so. Again, it's going to depend on the communication. So it's going to be a combination of short squeezes here, stops being broken, maybe some momentum and CTA kind of strategies, actually closing any residual short positions here, and forced to buy back those positions. So we could still have a bit more of a squeeze up here. And at that point, probably we all just have to sort of sit back and think for a little bit and say, well, is this enough? Is the market going to sort of sit back and say, well, hey, these deals are going to take a few months to really figure out. Tariffs will still, when all is said and done, be much higher than they have been historically? Or will the market simply say that, maybe this is a win-win situation, there's a lot less tension, global markets can deal with, another 5, 8, 10% tariffs, and that's a good thing. The other interesting thing is that it seems to be a big push in the Ukraine-Russia war for a May the 12th, which is today, ceasefire, and to try and bring Russia to the negotiating table. We'll see what happens there. But there definitely does seem to be a bit of a diplomatic push on to try and bring that a ceasefire to start negotiations on that terrible war. So again, a little bit of a risk-on sort of situation there. Other markets we can look at. What is interesting, obviously the NASDAQ ripping as well here. Probably it's got a bit more to go at this point. The small caps, the Russell doing well, but not as well, which is interesting here. You see the Russell not doing as well. So we'll look at something like the RSP, which is the equal weight. It's up pre-market, but not as much as the big sort of global tech companies as well. One thing I have noticed here, though, is in Europe, if you look at the European stocks, let's say the FESX, you see that it's up, but not quite as much as the as the US stocks. Also, if we look at the DAX here, only up about 60 sort of basis points, which is the German index here. And you can see that kind of spiked above, and maybe it's just taking a little bit of a pause because it's sort of saying, do we want to get this high? A new highs here. But it just looks like the Europeans underperforming a little bit the American stocks at the moment, just undoing that relationship, which has been going on for a while. Over in China, interesting to see what's going on here. So we see the A50, positive performance. We see the Shanghai 300, up, but not nearly as excited as the US stocks here. Also looking over at the Nikkei and things like the Topix, again, not a huge reaction. So most of the positivity has been in the US equity space. And again, something like the Nikkei here, actually sort of coming up to a little bit of resistance here. Other things, well, obviously in the bonds, as I said, we're getting this sort of flattener move here. You see that the 2-year is down, although it's coming off its low. And again, this is just based on this idea that the Fed, maybe less inflationary pressures if tariffs are not going to be so bad. Secondly, if there's less tariffs, the economy may not fall into a recession, so there's less room or need for the Fed to cut. So this is just going to push all ideas of the Fed needing to cut very quickly out a lot further. And you see that the front end here coming off hard compared to, let's say, something like the back end, also coming off in the US, but not quite as much. And you see that what that's has caused is a front end led bear flattener, which I will hopefully have the chart for here, which is, let's say, something like the 230s. So you can see that's kind of flattened. Again, it's come off its sort of lowest levels, but that flattening as the front end yields are going up much more than the back end yields. So that's a pretty typical reaction. So I think at this point today, we also have some announcements from Trump on pharmaceuticals, basically wanting to slash the cost of pharmaceuticals. Again, that at the margin is going to be a little bit deflationary for if pharmaceuticals is going to be less expensive in the US. But just in terms of inflation, if we start to get energy and oil prices going up, that could offset that a little bit just in terms of the calculus for the Fed. So we're going to have some Trump talk on pharmaceuticals. No doubt Trump will be sort of tweeting everything about this sort of China sort of semi-deal. Although again, it's just a framework to continue discussions. But the heat definitely has been lowered. So I think the minimum we can expect is not to argue with this for the next 24 or 36 hours, and just see how things play out. But we still don't have any kind of deal with the European Union, which is very, very important. And who knows? It may be that, if it looks like things potentially could come together with China, that might put a bit more pressure on the European Union to come to the negotiating table as well. We shall see. Okay, guys, I'm going to leave it there because I've got quite a few things to look after. So we'll keep the conversation going. Thank you. Have a great day.